The Dow Jones has hit a record high, and the Nasdaq.
I mean, I think next month's CPI it might be a little dicey, but after that, it's going to be all downhill. When the market goes higher like it has, market makers have to rebalance the market basically.
Sure.
Let me share my screen and we can look at some things.
I know you have been waiting for this because I have been waiting for this. What the heck is Dan Bird saying about what happened in the market last week? The Dow Jones has hit a record high,
And the Nasdaq.
and the Nasdaq, and the Nasdaq. Not yet the S&P, but maybe soon. And what does the rest of the year hold? Mr. Bird, take your victory lap. Well deserved. What the heck happened last week?
Where's my Nailed It t-shirt?
Yeah, it's funny. I need to mail you one. A couple of people have said that. I need to mail you one. I'll get your address offline, but
that's all right.
I'll give it to you in Vegas.
Yeah, that's a good idea. Sure. Yeah, pretty exciting, huh?
Yeah. So what? I mean, let's talk about it. What happened last week? What do you think it was? It obviously wasn't the fact that they held it constant. Everybody expected that. Right. It wasn't necessarily even the statement, which was kind of blah. Right. The Q&A offered a couple of tidbits. I think it was the dot plot that set everybody at Twitter. And
yeah, maybe.
Well, what do you think it was?
I think it was a combination of all those things. I think things got started with the CPI a little bit. Okay. Thursday is when it really took off. Mm-hmm. So I think keeping rates steady, even though everybody expected that, but basically saying that they foresee a 80 basis point decline in rates next year.
Yeah, so and no more rate increases. They're at their peak.
Yeah, well, we'll see about that. They also said they're data dependent still.
That's all noise.
But they probably are at the peak. I mean, I think next month's CPI it might be a little dicey, but after that, it's going to be all downhill.
Yeah, I agree.
So I think that's what it was. I think there's a lot of things. I think big Wall Street, I think, was caught offsides, and so they had to catch up.
Yeah, it's interesting you brought that up because Taylor, my Monday guest, who's a 10-year Wall Street vet, actually brought that up last week. Wall Street, as you know, but for the audience, Wall Street will be publishing to their investors their year-end report, and a lot of them were sitting on excess cash. Right. So a lot of them are putting that to work now, so that when they report December 31st, they're not sitting with all this cash and look like a moron.
Yes, exactly. Yeah, I think that was actually a big part of it.
Okay.
All the cash that they've been sitting on. I do think that I've been saying we were due for a pullback, and we haven't got a pullback.
Okay.
So we just had options expiration Friday.
Okay.
And many times, when the market goes higher like it has, market makers have to rebalance the market basically.
Sure.
Because market makers have to make a market on the other side of whatever the market's doing. So if the market's going up, they have to be selling. Okay. The market went up so fast that they didn't have a chance to. So when that happens, they usually will just step aside. So they won't try to sell. They won't try to stop. And that's true on the downside as well. Okay. When markets start to, drop off a cliff, market makers will just step aside and let it go. But they'll step in after options expiration. So next week is when they might step in and maybe start doing some selling.
Interesting.
But interestingly, next Friday is PCE.
Yeah.
Basically the last report of the year for the Fed.
Correct. Yep, correct.
And PCE is the one the Fed really watches.
Yeah, I've had a couple of people talk about it. They did back of the napkin math based on CPI and PPI, which are inputs for PCE, and they think it's going to come in, lower than expected back of the napkin because PPI was even weaker than CPI.
Right, that's right. And I think it will too. I think it will come in a little weaker than expected, and that I think will be the final catalyst to push all of the indexes over.
Okay. All right. That comes out, I think, 5:30 a.m. Pacific. So it comes out before the market opens Friday.
8:30. Yeah.
Yeah. 8:30 Eastern.
8:30 on Friday. And
Yeah.
then
So
and also, by the way, that happens to be the first day of the Santa rally.
oh, that's true. That's right. Yes. Santa Claus rally. We'll start tracking it on Friday.
Let me share my screen and we can look at some things.
Okay.
Okay, let's see here. So anybody that's interested, my free newsletter is right here on my website, breakpointtrading.net. Lots of good stuff in there this week. I talked about CPI a little bit, but I also showed the, let's look at the S&P right here. So there's the S&P. Right here where it went sideways, this is where I was saying, we're due for a pullback. It actually would be healthy for a pullback, but we never really got a pullback. So we blew right through the summertime highs. We're close to, this is the S&P, close to the March highs, March of 22, not quite there for the all-time highs yet on the S&P. But these two little candles here, Thursday and Friday, this is indecision. Those are spinning tops. The market went up, went down, went up, went down, ended up right where it started, basically. So that's one of the reasons, and it was options expiration. Look at the big volume down here.
Yeah.
That's typical on options expiration. You can look back here in September, back here in June. You can pick out the options expiration days just by looking at the volume. So with all that volume, the market didn't really do anything.
Yep.
Just kind of stayed where it was, which is, again, that's market makers trying to make a market on both sides after this big run up. And I think that next week they might, let it sell off a little bit.
Okay.
Profit taking, basically.
Right.
And then as it moves into Friday, moving towards Friday, or maybe on Friday, with a PCE number, it may take off for the rest of the year.
Yeah. The other thing I was hoping to see, and if you're going to get to it later, totally okay. But it does appear that we're getting a broadening out from the Magnificent Seven heavy to the mid and to the rest of the market, if you will. Is that? And if you want to cover it later, it's okay.
No, I said that in the newsletter as well.
Oh, okay.
If we look at, and there's another really interesting thing that happened too on Friday. So this is Friday's sectors. You can see there's two, the NASDAQ is on the top, two aggressive sectors and one defensive sector.
Interesting.
Outperforming the S&P. Now that was just one day. That was just Friday. But if we look at a full week, now the S&P is down here. Look at all of the sectors outperforming for the week.
Yeah. You think real estate likes lower rates?
Yeah, no kidding. Real estate, materials, industrials, discretionary, financials. There's the NASDAQ, there's technology and energy. That is a real mix of aggressive and defensive. That right there shows you that the market is broadening out.
Okay.
That's pretty clear. When all of those sectors are outperforming the S&P, then the market is broadening out beyond just the Magnificent Seven. And you can see the communication services, which is where the internet stocks are, is at the bottom.
Right. Lagging, yeah.
So,
okay.
So it's a pretty broad market. We can go back 1 month and you see the same thing. So it's not just last week, it's for the last month. The market has been broadening, and real estate's at the top again for the whole month. So, this has been actually going on for a little while now.
Like it.
What was really interesting to me, and I showed it in the newsletter, is the industries, or actually the stocks that were at the top. Actually, let me just go to my newsletter and go to that section. That makes it easier. So here's one other reason why I think we might get a pullback next week.
Oh, divergence, yeah.
Well, there's a divergence right there, but also these are the Keltner channels. I'll show it.
Actually, you're extreme.
Let me make this a little bigger. You can see how extreme.
Yeah, you're into the fourth band.
Yeah, we're in the fourth level. Not only is it extreme, it's parabolic.
Yeah.
So
that does not last.
That does not last. You can see right here it went 4x, you know, that's outside of all these bands. It's 4 times the average true range.
Mm-hmm.
And it hardly ever gets there. And when it does, it doesn't stay there very long. So that in combination with a negative divergence is one of the reasons why I think this is the Russell 2000.
Ooh, look at that. Damn.
Which has had a really good run. Here's the Dow and the NASDAQ. This is a weekly chart. So this goes back to the 2021 highs.
Mm-hmm.
So here's the Dow at the top. Blew through the highs. This dash line right here is the closing high.
Mm-hmm.
There were some intraday highs, but that's the closing high. So Friday, it blew through that. Here's the NASDAQ down below the closing high. It went above it there as well. Here's the S&P, not quite there yet, but pretty close.
Yep.
That's a closing high again. 48.18 is the actual intraday high.
Okay.
And we ended at 47.17, I think was the number. 47.19 we ended.
Okay.
On Friday. So we are, less than 3% away?
Mm-hmm. Yep.
This is one thing that worries me a little bit as well. So if we go back to 2021, when the market was making all-time highs, growth versus value was making lows. And I said that our very first video that we did was in December, just before New Year's, December of 2021.
Wow, 2 years. Thank you.
Almost 2 years ago. And I was talking about this then, that I was worried because the market was making all-time highs, but looked like there was rotation out of growth and into value.
Right.
And that looks like what's happening now too.
Ooh, interesting.
All right. So growth to value right there, even as the Qs goes parabolic, and the Russell 2000 is even more parabolic.
Wow.
So that doesn't mean the market's going to crash. It doesn't mean we're going to do the same thing we did in 2022. We won't, because the market, remember, is always 6 months ahead of the economy. And the Fed didn't start cutting until third week of March, right down here. But the market was anticipating it in December. So 4 months ahead, it knew the Fed was going to start start hiking.
Yep.
Even though it didn't start till March, but the market knew. The market knew it was going to start hiking. So the market started going down. That scenario is not what we have right now. Today.
Yeah, I would say the market's predicting some hefty cuts.
Yeah, but if we do get the cut, I don't think we're going to get a cut anytime soon. But be careful what you wish for, because if we get a cut, that means we are in dire straits. The rates right now are normalized.
Right.
People might think they're high, and I've heard talk about higher for longer, but they're not really high. They are where they normally are.
Well, let me ask you this question, because I believe, and if you disagree, tell me, but I believe the Fed could cut even without a recession.
Why?
Because inflation falls faster than expected.
That's not why they will cut. And anytime if you hear anybody say the Fed is going to cut because inflation is falling faster, that's the wrong reason. That is not why the Fed will cut. The Fed has 2 mandates, and everybody keeps forgetting the second one.
Yep.
Inflation is the first one, but the second mandate is unemployment.
So let's try to put some numbers around this. So you believe?
So let me go here. I have a recession watch on my website now.
Oh, look at you.
Here's the unemployment rate right there. You can see every time unemployment goes above this blue, the pink goes above the blue. So that's a 3-month. This is the SOM rule.
Yep.
Recessions start when the 3-month moving average, which is the pink line, rises by more than a half a point above the 12-month average.
Okay.
All right. So if you notice here, one above it there, 3 months later, recession. One above, 3 months, recession. This one was really quick. COVID recession happened really fast. All right. We were almost there when we got to 3.9. We were almost there. And then we got a 3.7.
Right.
Started going the other way. So this is the reason the Fed will cut, not because inflation is coming down. And to highlight that, let me show you. I think this one here shows it. So here's where we are right now.
Mm-hmm.
Here is what the Fed rate was in 2006.
Mm-hmm.
Almost the same as where we are right now. All right.
Okay. Yep.
Now this chart goes back 33 years. And this level that we're at right now, and you can see back here in the 90s, we're actually a little bit higher than that for longer. This is the average. If you go back even further back than 33 years, the level we are right now is normal. This is the normal level. This is what the Fed wanted to get to. A normalized level. So yes, they may keep it here longer, but they are not going to cut just because inflation is coming down.
We disagree. Just to be clear, because I'm sure the audience is already knowing, I disagree with that.
Okay, that's fine.
Yeah,
we can disagree.
That's fine. Absolutely.
But the Fed will not start cutting until this happens. So you shouldn't be looking at inflation. You should be looking at the unemployment rate to determine when the Fed is going to start cutting.
So again, I want to make my opinion clear. I believe that if we skirt a recession, and again, I think we have a recession, at which point this all becomes mute. But if for some reason we have very minimal positive growth and unemployment doesn't spike to 4.5, I believe the Fed could still cut if inflation falls. I actually think inflation is much lower than what has been reported if you correct for shelter. And I did that today on my daily financial news. I corrected for shelter, Dan. I don't think you saw it, but if I've done my math correctly, CPI is actually 0.55, not 3.1. And I
don't necessarily disagree with that, although shelter went up in this last CPI report.
Yeah, watch the report. I did the full math for folks. I believe the Fed is deathly afraid of deflation. And if we're at 0.5% inflation, that's awful close to deflation.
That's very close to deflation.
Right.
But
so
But I mean, deflation is a problem. But here's what I think is going to happen.
Okay.
Let me go back to this. Let me go back to the unemployment rate.
Mm-hmm.
The Fed has basically telegraphed that they're probably going to start cutting next year. They haven't said exactly when that's going to happen.
Yep. I think that's correct.
But they will be cutting at some point next year. Now, I don't think the cuts are going to happen until the end of Q2.
Okay. I think that's fair.
But what is going to happen is, and I think it's already started actually, is major corporations, especially capital intensive corporations, are going to delay taking out loans for capital purchases. Correct. Because they are expecting rates to come down.
Okay.
They will delay their loans.
Sure.
Delay capital purchases, which will slow the economy, which will cause them to lay people off as they wait for lower rates so they can then start producing.
Let's ask I think where we did. So where do you think unemployment goes by the summer?
So by the summer, I think it's going to be in the 4.2 range. Okay. 4.2, 4.3, somewhere around there. It might be 4.5 even. If it gets to 4.5, then the Fed will cut.
Oh, I totally agree. If the Fed, if unemployment goes to 4.5, the Fed's cutting and probably cutting by more than a quarter, and probably cutting at several meetings in a row.
So we might be saying kind of the same thing, just in a different way.
Yeah.
You're saying the Fed's afraid of deflation. I'm saying that basically the telegraph that they're going to cut rates is what's going to cause deflation, because companies are not going to be producing.
They'll change their behavior. Yeah,
they're going to change their behavior, right? However, I will also say that we've had, let's go back. Let me see if I've got the chart of I don't know if this one shows it, but this is the inverted yield curve, which still hasn't gone back above zero.
Correct.
But if we go back, oh, it's a CPI. Probably I don't have a CPI chart that goes back like that. But the thing is we had 9.2, and then we had, it came down to 7 and 6 and 5 and 4 and 3.
Yep.
Which everybody's saying, great, inflation's falling, which is true. That's disinflation.
Correct.
But we still went up 9%, and we still went up 7%, and we still went up 6%, and we still went up 5 and 4 and 3.
Correct.
So if we have deflation for a short period, that actually will be a good thing. The danger of deflation is that it starts to snowball and become self-fulfilling and continues.
Correct.
So deflation in and of itself is not a bad thing. It brings down that 9, 7, 6, 5% increases that we've had over the last year. Remember, all those increases are still there.
Oh, absolutely.
Just because the rate has changed each month doesn't mean the inflation has come, the prices have come down. The prices are still at those inflated levels.
Agreed.
So the change in the rate just means that we are not going up as fast as we were before, but the prices are still up there. Deflation means the prices are actually coming down. So I don't think it's a bad thing to have deflation if it's temporary enough.
No, that's the key. That's the key.
Yeah, that's the key. The danger is that it will continue.
Yeah,
the danger is that people will say, I'm not buying anything because it's going to be cheaper next month. And
if that takes over,
right,
things really break in an economy that is debt-based. Correct.
Right. So I think I agree that the Fed is afraid of deflation. I don't think that they are as afraid of it as you think they are. I think they are willing to have deflation for a short period.
Short period being 3 months?
Like 3 months, yeah.
Okay.
3 or 4 months, and long enough for a recession to occur.
Okay.
And I think there probably will be a recession as well. If I look at the recession watch, there's unemployment. Every time it goes up to this, this level, we get a recession. There's rate hikes and recessions. Every time the Fed lowers rates, 3 months later, we get a recession. So if the Fed drops rates, by the way, and I said this in my newsletter, be careful what you wish for. If the Fed lowers rates, everyone thinks that's going to be a good thing. And initially it will be.
Right. But
they're lowering rates because they see something bad coming.
Exactly.
And as soon as they start lowering rates, my recommendation, when that happens, my recommendation in my newsletter to everybody is get ready to take your profits and run or go short. Okay. Because if we then transition into a recession, even though, as I've always said, it will be short and shallow, the market will still go down.
Oh yeah, the market will change PE ratios.
That's right. You can look at this red line is the S&P. So, yeah, red line's the S&P. So here's a recession. Look how far it dropped. Here's a recession. We started going down in 2000. The recession happened in 2001. This is COVID. It would happen so fast that, it went down pretty fast, but it came back pretty fast as well.
Yeah. That's a V-shaped recovery right there.
That is a really V-shape. So this is what will happen in a recession. Even if it's shallow and short, the market is going to go down. So when the Fed starts cutting rates, be really careful.
Okay.
Because it means the market's getting ready to go down.
Yeah, and you're thinking summer-ish.
I'm thinking end of Q2 at the earliest.
Yeah. Okay. Yeah, because I think you've seen the market is really starting to price in March.
Yeah, that's fine. Market can price in whatever it wants. That doesn't mean the Fed's.
It's been wrong for 2 years in the Fed. Yeah. That's very clear.
Yeah, that's right. The Fed's not going to. The Fed's not going to do that. The Fed really likes where it is right now. Okay. The Fed is looking at what's happened right now and saying, this is exactly where we want to be. So, this is 14 months back here in 2006. We are 3 months into this one right now.
Yeah.
So we could go another 6 months and still not be as long as this one.
Mm-hmm.
Right.
Yeah.
So we could easily get to, the only thing that's going to derail all of this is the scenario that I just painted, that capital intensive companies will stop taking out loans and stop expanding and stop building new warehouses and
Can you go back to the unemployment chart? Other than the COVID recession, which unemployment spiked crazy in 1 month, has unemployment really moved that quickly before? Oh, it moved pretty quickly in 08. Yeah.
Yeah, 08, it moved up pretty fast. In 2000, it moved up pretty fast.
Okay. So we're talking a couple of points.
And all the recessions, it moved up very quickly. And that's what happens with unemployment. That's the thing about unemployment. It's even more so than the CPI and inflation.
Yep.
It snowballs once it gets to a certain level. If this gets, and that's what this SOM rule is all about, basically. Correct. When the 3 month, the pink line rises by more than 0.5% above the moving average.
Okay.
But what happens if this gets up to 4.2, then it is going to very quickly get to 5.
Oh, okay.
And that's where the recession happens.
Oh, 5, yeah, for sure, no doubt.
See, that's what happens when the unemployment rate starts to spike like this. And this is the thing you have to watch, not inflation, to determine when the Fed is going to cut. Just my opinion.
Yeah, of course. Yeah, I love talking about this stuff. Awesome. What else did you see last week?
Let's look at a couple of other interesting things. First of all, let me look at renewable energy. So look at that.
Yeah, the solar stocks.
Solar stocks, they love lower rates.
Yeah, they do.
In fact, if I go, let me see if I can get here real quick. If I get to this really amazed me actually when I saw it. I don't think that's going to do it. I think it's actually in the newsletter. Let me bring my newsletter back up again. If I can get to that real quick. Because when I saw this, it was pretty amazing. Let's see if did I put it in here? Okay, here we go. So here is the top and bottom 10 large cap for last week. Top 10. Solar Edge, Enphase. Look at the industry groups. Renewable energy, renewable. Yep. First Solar. 3 out of the 10 were in the top 10 best performing for the week.
Now, do you think that was short covering? I think these stocks were all heavily short.
Absolutely short covering. The week before, they were in the bottom.
Ah, were they?
Oh. So here's the bottom. Oracle's in the bottom.
Yeah, they did not. Yeah. Oracle.
Yep. Pfizer's in the bottom. Cardinal Health, Johnson Controls. But Solar Edge, Enphase, and First Solar were in the bottom last week, the week before. Interesting. Yes, absolutely. It's short covering.
Okay.
But it could still continue. Sure.
Maybe.
And if we look at small and mid caps, Sunrun, renewable energy.
RH. Wow. Home improvements. That's funny.
Two of the 10 were renewable energy in the top 10 for small and mid caps.
Wow, 44%. Jeez, that's a nice run.
Up 44%
in a week.
And this PLAB, even though it says technology, it's really in the renewable energy space.
Okay.
So that was just incredible to me to see that.
Yeah.
By the way, this is something that I do on my website every day. I rank all of I'll show you the page. It's market bias. I rank the bias of all these different categories.
Yep.
Indexes, sectors, industries, commodities, metals, currencies. Notice how it's all red down here.
Yep.
Under commodities, and it's all green up here. But more importantly, and if I go back to the newsletter, this is a better view of it. I'm tracking this on a week-to-week and day-to-day basis. So I have enough data now. This goes back 3 months. I have enough data now so we can actually see the trend visually. If I bring this down a little bit. All right, so you can visually see the trend, right?
Yeah.
It's all red and yellow down here. It's all green and yellow up here.
Hmm.
And if you look at the chart over here, this is really cool, I think. Is right back here in September, October, beginning of October, just before the big run up.
Yeah, short
The
term.
orange line is short term. That's a short term trend. The gray line is medium term, and the yellow line is long term.
Yeah, look at that.
So the short term crossed first and started up. Then the gray line started up and crossed over the yellow one, and now the yellow one is catching up.
Hmm.
And these are all kind of going sideways, which is very bullish. When all these get up near the top, get above 60%, and it all moves sideways, that is a very bullish market.
Interesting. Okay.
So it's interesting because I track it every day, and I'm starting to put little boxes around the ones that changed each day.
Mm.
So we can see down here that gold just gave a short-term bullish signal.
Mm-hmm.
And if we click, and this is in the newsletter too, if we click on gold, you can see it had a nice run and then it pulled back, and it looks like the run is beginning back again.
Hmm.
The other one that appeared on Thursday, it's not on this one because this is Fridays, but on Thursday, lithium turned bullish, turned from bearish to bullish. And this has been bear all across the board for a long time for lithium. If we look at that, it looks like lithium is just beginning its run. Hmm. So lithium stocks might be a place to be right now. Hmm. But that's something that, I didn't really think about when I put this together. I just wanted to see visually what the market was doing. But now I'm starting to notice when these things change on a daily, the short-term basis, that's the beginning of a run. That's the beginning of when something really starts to move.
Okay. Makes sense.
So I'm going to continue to track that. And on that same note, I talked about before about this portfolio from Turner Capital that I'm experimenting with.
Yep.
And I put my own money into it. But it's basically this idea that you look at a weekly of the overall market, and when these moving averages turn to green, then you get in. When they turn to red, you get out. When they turn to green, you get back in again. Mm-hmm. And those can last for quite a while.
Yep.
But using the QLD, which is a 2x, that's double the return of the index. A QLD is a leveraged 2 times the Qs, basically. And if I look at this on a weekly basis over the long term, going back to COVID, you can see here that the signal was to get in there and get out here. So that's almost 2 years. Yeah. A little over a year and a half, 188% return.
Not bad.
just by following that. So right now we're right here. So I decided to actually track it with my own money.
Yep.
And after 1 month, it's up 8%.
Okay.
In 1 month. So we'll see how it goes. But
you're not fully allocated, right? You put up 100, I think.
Yeah, I'm actually 50,000 into it right now.
Yeah, so you're half. Okay, got it. All
right. So, I think the market is due for a pullback. Mm-hmm. For a lot of different reasons, but because of all that money on the sideline, like we talked about, I mean, that could be the fuel to keep pushing it higher.
I mean, yeah, I mean, the more and more, I'm thinking again, Taylor brought it up. These big Wall Street guys have, crazy cash balances, and they certainly don't want to be, showing cash at the end of the year when, the markets are up 20%.
Right. Absolutely. But a lot of them are moving out of the Magnificent Seven.
Correct.
And a lot of the money's moving into small caps.
Mm-hmm.
So if we look at the breadth analysis right here, this is where you can see, we've looked at this before. And I think if you remember last time, about a month or so ago, small caps were taking a beating, remember?
Yep, I remember.
So here's the NASDAQ 100. Here's the New York Stock Exchange. Here's large cap. This line across here is the 52-week high.
Oh, got it.
So okay. Large cap broke through, small cap broke through. Mid cap broke through, and small cap is now catching up. So small cap is the one that's really playing catch up right now. And I think a lot of that Wall Street money, if we look at the Russell 2000 on a 3-year basis, you can see over the last 2 years, the Russell 2000 has just gone sideways.
Yeah.
This is mid and small cap stocks.
Got it.
And right now it's right at the top of that channel with huge volume. So this is the place that I think a lot of the breakout is going to occur in this mid to small cap area.
All right.
And again, that broadens the breadth, right?
Correct.
It's not just the large caps anymore. Everybody now is participating. Everybody's in the game.
Yep.
So that's good for the market. If we look at the high-low chart, which is interesting.
It's got to be screaming high. Yeah.
You know, I talked about this before that we needed to see this go into the black. This top one up here is new highs minus new lows.
Right.
So if it's black, that means there's more new highs than there are new lows. And it's getting bigger and bigger. The bars are getting taller and taller. And then down here is the Association of American Investors, Independent Investors. So this is getting up to the point, this is overly bullish up here. Very, very bullish.
Yep. That's
usually the point when the market pulls back.
Yeah, it gets exhausted. Yep.
Right. You can see right there, back over here, wasn't that high, but it was the highest that it had been. So we're getting to a point where the market could get exhausted and pull back. And I think next week it will have a chance to pull back before that PCE number.
Okay.
And then watch out for that last week of the year. Last week of the year, I think the market has the potential, especially with PCE coming in lower, has the potential of just taking out all the old highs.
Okay.
Which is what I've been saying since the beginning of this year.
Yes, you have. We have receipts.
Yep. So everything looks really good. I mean, it's a Goldilocks scenario. I was on a webinar with another investment company, and they said Goldilocks may be entering the building.
Oh,
and I
okay.
and I typed in the message box. I said Goldilocks is just finishing her porridge. And she's going over for a nice soft bed to lay down in.
There you go.
She's been in the building for a while now.
Very, very cool. Well, any closing thoughts? And let's show your newsletter one more time.
Yeah, the only closing thought I have is that the market needs to take a break. I think next week might be that opportunity.
Okay.
But I think it still wants to go higher. So the Santa Claus rally, I'm going to actually track it here. So here's last year's.
Yep.
So Santa Claus rally, or the January barometer. Santa rally starts on the 22nd. It's next Friday. And then we've got the first 5 days of January, and then we've got the whole month of January. So last year, all three of these were positive.
Right.
And every time that happens, this is according to Stock Traders Almanac, anytime that happens, the market ends the next year higher. So we want to see if all three of these can be positive again. So starting next Friday, I'll have a chart in here that will start tracking all of that.
Awesome.
So I think the market wants to go higher. I think it's going to take out all of those all-time highs. I think it has the potential of carrying that through into next year, into January, because all of those big Wall Street guys who have cash sitting on the sidelines are putting it to work. They are, and all of the 401k and IRA money that will be deposited at the end of the year, all of that is going to have to be put to work beginning of January. And all of that is going to continue to push the market higher in January. We could hit 5,000.
Wow.
Early next year.
Very, very cool. Well, Dan, thank you for being here each week. We appreciate you. The audience loves you. They love your midweek updates. So I'll thank you for the audience. They really look forward to our discussions and all their information.
Absolutely. Yeah. I like doing the midweeks when I can. Usually a lot of stuff happens right in the middle of the week. So it's good to just, inform everyone on where things are. And then the newsletter is right here. Just go to my website, breakpointtrading.net, and click on this button, and you'll get the newsletter. If you want to get notified when the newsletter is available, at the bottom of the homepage, you can register your email under this $0. So it won't ask for a credit card or anything, but you'll register your email, and then I will notify you when the newsletter is available. And then if you want all the other stuff that's on the site, it's $99 a year.
There you go.
But the newsletter's free, so.
Yep. Dan, thank you so much. You're amazing. Take care.
Thanks again. Have a great week. Good talking to you. I will not be here next week. I will be on a cruise. for Christmas holiday.
Good for you.
So I guess the next time we might talk is just before, right at the end of the year. We'll be done.
There you go. We'll wrap it up. We'll
December 30th. December 30th will be the last one for the year.
There you go. I look forward to it, buddy. Take care.
All right. Have a good week.
Bye.